So we're going to build on what we discussed yesterday about the audit reporting. So once we finish with the audit reporting, we move on to the audit of historical information. So yesterday we discussed basically all the issues under audit reporting. And I told you that for the purpose of the ICAG exam, you can be given a question on reporting to shareholders or reporting to those charged with governance or management. But the popular one or the common one, what you meet in the exam room, will normally be reporting to the shareholders in a form of the formats that we just discussed yesterday. So we were on the modification of opinion. So we discussed standard or modified audit reports. Then we also discussed situation where the report will be modified, but the opinion will still be a modified opinion. And I remember telling you that anytime you introduce the emphasis of matter paragraph and other matter paragraph, what it means is that the opinion is still a modified opinion. It's still the true and fair view of the company's state of affairs, but the report has been modified. Good. So with the modification of opinion, I told you that we have three types of modification of opinion. That is a qualified opinion, adverse opinion, and a disclaimer of opinion. So three things. But please note this. When you are writing your audit reports or under audit reporting, if your opinion is a modified opinion, the heading opinion in the report should read in line with the level of modification. So what it means is that if your audit opinion is a qualified opinion, the heading opinion should read qualified opinion. Then the basis for opinion is supposed to be basis for qualified opinion. If your opinion is a disclaimer of opinion, then the heading opinion should read disclaimer of opinion, and the basis should be basis for disclaimer of opinion. If your opinion is adverse audit opinion, then the opinion section in the audit report should read adverse opinion, and the basis should be basis for adverse opinion. So note that if you are asked to criticize audit reports and the opinion is still opinion, but the content reads that the financial statement does not show the true and fair view of the company's state of affairs, what it means is that the heading opinion is wrong. If it is a qualified opinion or adverse opinion or disclaimer of the opinion, the heading should read adverse, disclaimer, or a qualified opinion. So please, you have to note that. So as a technical person, when you pick any audit reports and you've seen that they've written opinion, it should tell you that the content will read true and fair view because there is no qualification attached to the opinion. When do we express adverse opinion? When do we express a qualified opinion? And when do we express a disclaimer for opinion? I explained that yesterday. So let me repeat what I said yesterday. I said that when it comes to modification of audit opinion, be looking out for whether you have evidence or not. And you need to also find out whether the financial statement is materially misstated only, or the level of misstatement is material and also pervasive. So if the misstatement is material and pervasive, that's a different level. If the misstatement is material only, so if the misstatement is material only, whether you have evidence or not, the appropriate audit opinion is supposed to be qualified audit opinion. So when we talk about qualification of audit opinion, we have two types of qualification of opinion, or two categories of qualification of opinion. If you have evidence, but the financial statement is materially misstated, you can qualify your audit opinion. Typical example is, let's say the provision in IFRS 5, non-current asset held for sale and discontinued operation. The standard says that once you classify an asset as a held for sale, it's supposed to be measured at the lower of carrying amount and fair value less cost to sell. That is the provision in the standard in the IFRS 5. So if you realize that management are measuring held for sale assets at the higher of carrying amount and the fair value less cost to sell, and you realize that that figure is material, We've also discussed the concept of materiality. So what you need to say is that, or in your opinion, you state that a set for held for sale assets, which have been measured at a higher of carrying amount and fair value less cost to sell, instead of the lower of carrying amount and fair value less cost to sell, everything shows the true and fair view of the company's state of affairs. That is a qualified opinion. We use the term a set for qualification. So that is where you have evidence, but you realize that the financial statement is materially misstated and it's only material. Another one is where you have been limited on scope in terms of evidence. You don't have evidence, but the evidence you are looking for is only material, but not pervasive. So for example, you have confirmed almost all the figures in the financial statement, but the inventory, you want to undertake inventory count. But management are telling you that the storekeeper is not around to undertake inventory counts. And you realize that that figure is material. You use a qualified opinion, or you express a qualified opinion by stating that a set for inventory where management were not able to attend inventory count, or sorry, except for inventory where the audit firm were not able to attend inventory counts, everything shows the true and fair view of the company's state of affairs. That is still a qualified opinion. So we use qualified opinion where the financial statement requires qualification. So that is where we use qualified opinions. So we're going to use qualified opinion when the financial statement requires a qualification, whether the qualification is in a form of limited in scope, where we don't have evidence, or where we have evidence, but we've been able to prove that the financial statement is materially misstated. Now, we're going to express adverse audit opinion where we have audit evidence, but we've been able to prove that the financial statement is materially misstated and it is also pervasive. So we have audit evidence, but we've been able to prove that the financial statement is materially misstated and it is also pervasive. So you realize that the treatment of the inventory figure is not in line with the standard. The treatment of the PP is not in line with the standard. The treatment of the intangible assets is not in line with the standard. Almost everything is wrong. It means that the misstatement is not only material, it is material and also pervasive. And because it is material and also pervasive, as an auditor, the appropriate audit opinion is supposed to be an adverse opinion. That is where you state that the financial statement does not show the true and fair view of the company's state of affairs. So that is adverse opinion. The last type of modification is a disclaimer of opinion. Disclaimer of opinion is where you have been limited on scope entirely. Before you can express an audit opinion as an auditor, you need evidence. And we've discussed that we need we also need appropriate audit evidence to be able to express audit opinion. So you go to the client and the client is not able to give you evidence. You make inquiries, management are not ready to talk to you. You request for documents, they don't want to give you the documents. You want to make inspections and they tell you that the asset is not available or the responsible officer is not available. It means that it will be very difficult for you to get an evidence to express an opinion. So you issue a disclaimer of opinion. That is where you state that we cannot express audit opinion because we don't have audit evidence to be able to express audit opinion. So that is a disclaimer of opinion. You cannot express opinion because you don't have the evidence to be able to express audit opinion. Good. Now, so that is for the modification of opinion. Yesterday, I told you that when it comes to going concern, and you realize that the disclosure requirement per the IAS issues on going concern requires a disclosure. So if you realize that for going concern, the disclosure requirement is adequate. So what is supposed to disclose per the standard, it has been disclosed, is adequate. And the going concern assumption used by management is appropriate, just that there are material uncertainties. what you need to do is that you need to show a line or a section in your audit reports. And that section may come before the key audit matters or after the key audit matters. So you call that section material uncertainty ongoing concern, and you comment on it. Please, still ongoing concern. If you realize that the disclosure requirement is not adequate, but the assumption is appropriate with material uncertainty, then you have to qualify your audit opinion because it requires a disclosure and they have not disclosed it. So the opinion is supposed to be qualified. But if you also realize that the disclosure requirement is not adequate, the going concern assumption used by management too is not appropriate. Don't forget that issues of going concern is a fundamental issue. So with that, you issue adverse audit opinion. So if you are told that, or if you realize that the going concern assumption is not appropriate, then the disclosure requirement too is not adequate. As an auditor, you give adverse audit opinion. But if the going concern requirement or assumption is not adequate, but the disclosure requirement is okay, please, what you can do is that you can also use emphasis of matter to cater for this particular issue. Okay. Mary, you can go ahead with your question before we move on to other issues.
Yes, please. So, do you issue adverse because there's a limitation of scope?
The deduction might be
Mary, unmute yourself and ask your question again.
Yeah, please. I was asking in connection with the adverse opinion. I'm asking if it's because there's a limitation of scope. If you say it is not adequate, as in because it's limited when it comes out, or because
please, are you referring to the going concern?
Yes, please.
Okay, so with the going concern, don't forget that it is the responsibility of management to assess the going concern level of any company. Once they assess per the standard, they have to disclose. But we auditors, it is our responsibility to assess the reasonableness of the assumption used by management when it comes to going concern. If the assumption used by management when it comes to going concern is not reasonable, the assumption used by management when it comes to going concern, if it is
we are looking at those who are retiring,
if the assumption used by management when it comes to going concern is not appropriate, and the going concern, so if the assumption is not appropriate, but the going concern disclosure too is not adequate, what they're supposed to disclose, they have not disclosed it. It means that everything about going concern is wrong. And issues of going concern is seen to be material and also pervasive. And that's the major reason why we are using the adverse audit opinion. The disclosure requirement is not okay. The assumption too is not appropriate. And because it's a fundamental issue, it's a game over. So we have to issue adverse audit opinion when it comes to going concern. Please, Mary, are you okay with that?
Yes, please. Thank you, sir.
You're welcome. So that is for going concern. So let me talk briefly about reporting to management and those start with governance so that we go to the main topic for today, which has to do with the audit of historical information. We're going to look at the audit methodology. So as an auditor, what method can you apply or adopt in performing your audit work as an auditor? Now, with the reporting to management and those charged with governance, we're going to report the internal control deficiencies that we have identified during our audit. So when we are undertaking our interim basis,
they made a competition of their National Executive Committee, man. They made a constitution of almost 99%.
Sorry, let me mute them. Okay. So with our interim basis, or when we are undertaking control tests, all the controls that we have identified during our audit, we will just write it and issue a letter to management. That is a management letter. That is a reporting to management and those charged with governance. Our core responsibility is to report to the shareholders as external auditors of the company. Don't forget that for purposes of corporate governance, those who are managing the activities are different from the owners. So the owners also need an independent body to conduct examination on the financial statement prepared by management, just to express an opinion on it, as to whether the financial statement shows the true and fair view of the company's state of affairs. So as an auditor, how do you communicate with management and those charged with governance? You're going to communicate all the control deficiencies that you have identified during your audit. So you tell management in a form of management letter. So please, it's a letter that you address to management. So the address will come to the management, then the heading will be management letter. You start the content with the introduction. So with the content, you start with the introduction. That is where you introduce your management letter by telling management that you want to thank them for giving you the opportunity to conduct audit in their outfit. And you want to share with them the internal control deficiencies that you have identified during your audit. So that is going to be part of the introduction. And as part of the introduction, you can also add that okay. So please, with the chapter in the manual, I will mention the chapter before we close. But somebody is asking those charged with governance. So we're talking about those who are managing the activities. So the executive board members, those who are managing the activities. If you want to communicate with them, what do you normally communicate with them? So the governance or the board and the management, what do we normally communicate with them? Okay. So please, I was checking the chat box. So please, if you are communicating with management and those charged with governance, so the address will come, then followed by the introduction. So let me share with you the introduction. So with the introduction, that is where you state that you are thanking management for giving you the opportunity to audit their outfits. Then you tell management that these are some of the internal control deficiencies that has come to your attention during your audit. Then you have to manage your report. How do you manage the report? You add that this may not be the control weakness that exists in the client system. So you need to add that this may not be the control weakness, the only control weaknesses that exist in their system, but these are the control weaknesses that has come to your attention during your audit. Please don't forget that it is not your responsibility as an external auditor to be auditing the controls. It is the responsibility of their internal auditors to be checking the controls, be using their audit committees to also check the control. But all the control weakness that has come to your attention, you want to draw the attention to the control weakness. So that is going to be your introduction. Then after the introduction, you go straight to the content. And with the content, you talk about the control weakness. You discuss the impact of the control weakness and possible recommendations. So the control weakness, the impact, and possible recommendations. So what would be the control weakness? So for example, if you realize that in the finance unit, you have one person keying the figures, writing check, keying, writing check, and doing basically everything. It's a control weakness. You just raise it. That's a control weakness. What would be the impact? It can lead to fraud. Okay, somebody is sitting at one place for about 20 years. The person doesn't want to go on leave. It's possible that the person is sitting on something. It's a control weakness. The impact is that it can lead to fraud. So that is the impact. Then you make recommendations. So with one person doing basically everything, you recommend that management should engage a lot of hands to help in managing activities within the finance unit. So after your recommendations, you just identify all the control weakness. and you make possible recommendations. Discuss the weakness, talk about the impact, and make possible recommendations to management. So when you finish, then you conclude. So in conclusion, what do you have to say? So in conclusion, you tell management or you thank management once again and tell them that you are available to help management implement your recommendations. So all the recommendations that you have given to management, you tell them that management can contact your firm anytime to help management implement your recommendations. So that is going to be the content of reporting to management or reporting to those charged with governance. It's not that popular in the exam room, but it's also examinable if you are not given a question on the normal reporting to shareholders, which we have discussed, the qualified opinion, adverse opinion, modifications, and the rest. So please, that is audit reporting done. If you have a question, you can ask. If not, let's move on to another important topic. That is the audit of historical information. Those who will be writing this very paper, audit of historical information will be in the exam room for minimum 35 months. Minimum 35 months. So it's key so far as the exam is concerned, because that is a real audit. That is a real audit. I remember in one of my lectures about 4 or 5 years ago, a student asked me, when are we going to learn the real audit? Because we're learning auditors, liability, ethical issues, reporting, and the rest. So we are now going to learn the real audit. And the audit of historical information, for the purpose of your exam, please concentrate on audit methodologies. So the method that you can use or the approaches that you can use as an auditor to conduct your audit work. Audit risk identification. So audit methodologies, number 1. Audit risk identification, number 2. Business risk identification, number 3. Audit procedures and audit evidence. So procedures that we follow to perform audit work. The procedures that we follow to get audit evidence. Because without evidence, you cannot write your reports. So the procedures that you're going to follow to get audit evidence, how do you evaluate? How do you review any item in the financial statement? So evaluation and review of items in the financial statement is key. So these are the most examinable areas so far as the audit of historical information is concerned. Good. So before we...
Hello, sir.
Okay, Ike.
Sir, which chapter can we find this particular topic in your material?
Okay, for audit of historical information, it is in chapter 10 of my material.
Chapter 10. Okay, sir. Thank you very much.
You're welcome. Chapter 10, yes. So there are a lot of issues in chapter 10, but I'm trying to share with you the important ones, the key ones that you need so far as the knowledge is concerned and the exam is concerned as well. So before we go into the audit methodologies, the method that we can use to perform the audit work. Okay, the question is, kindly give a quick overview of the audit of historical. Okay, so please, audit of historical information means you are auditing the financial statement, because the financial statement is a historical information. You're going to audit a financial statement that has been prepared already. It's a historical, it's not a prospective financial information. So when we are learning a bit of other assignments, that is where we look at some prospective financial information. So we are calling it audit of historical information because you prepare the financial statement before you audit. So what it means is that you are auditing a historical information. And with the audit of historical information, like I mentioned, the key things becomes the methodologies or the approaches, the audit risk identification, business risk identification, and how to get evidence, audit evidence, review and evaluation, performing analytical procedures, and the rest, which is also part of the audit evidence, and how to undertake a transnational audit, a joint audit, and audit of consolidated financial statement, where you have the main audit of the entire group. So audit of the parent and its components. They are all in the audit of historical information. Now, generally in auditing, or before we perform our audit work, we need to plan, because if you don't plan, it becomes very difficult to perform your audit work effectively and efficiently. So planning is very, very important. And when we talk about audit planning document, the key document in there is what we call the audit strategy. So the audit strategy deals with the characteristics of your audit engagement, your audit client, the resources that you need to perform the audit work. So how you prepare yourself to undertake the audit assignment becomes the audit strategy. So for planning, it's just activities that you're going to follow in order to perform the audit work. And when you are planning your audit work, normally we undertake 3 phases. So I'm just summarizing this because it's not that important so far as the exam is concerned. So we have the initial phases, the interim phases, and the final phases. So with the initial phases, after you have agreed on the terms of engagement, you visit your client for the first time, just to have understanding of the entity and its environment. Please, as we know, per the ICAG 315, International Standards in Auditing 315, if you want to obtain risk of material misstatement, it is appropriate to have understanding of the entity and its environment. If you don't have understanding of any entity and its environment, it becomes very difficult to audit that particular client. It's a provision in the auditing standard. We need to obtain understanding of our audit client and its environment. So with the initial phases, what you do is that you just obtain understanding of your audit clients and its environment. You'll be making inquiries, be reading about the company just to have understanding of the entity and its environment. Then your interim phases is where you want to test the controls. You want to test the accounting systems of the client to find out whether the controls and the accounting systems of the client are effective or not. So after testing the controls, that is where you normally issue a letter to management or the management letter spelling out the internal control deficiencies that you have identified. Then your last visit is going to be the final visit. And with the final visit, what you do is that is where you conduct the actual audit work. You'll be making inquiries of management. You'll be recalculating figures in the financial statement. You'll be performing analytical procedures. Then after everything, you draft your audit report. So these are the 3 main phases that we undertake when we are performing our audit work. Now, let's move on to the main thing that I want us to discuss, and the audit of historical information. That is the audit methodologies, or the approaches that we can adopt or apply when we are performing our audit work as auditors. Please, ICA can ask you a question on any of the audit methodologies, or the examiner can list any of the methodologies for you to explain. So we need to have understanding of the methodologies. And practically, we are not restricted as auditors to apply only one method when we are performing our audit work. We can apply as many as 3 or 4 methods when we are performing our audit work as auditors. So we can adopt 5 different audit methodologies. You can also go for 3 or 2 audit methods when you are performing your audit work as an auditor. Good. So let's look at the methods that we can adopt or apply when we are performing our audit work as auditors. Number 1, the first method that I want us to discuss is the risk-based audit, the risk-based audit. So with the risk-based audit, it's part of the audit approaches or the method that we can use, the risk-based auditing. Risk-based audit means that as an auditor, if you want to adopt this particular method when you are performing your audit work, you concentrate on the risk areas. So if your audit work is directed to only the risk areas, then it means that you have adopted the risk-based auditing. Risk areas are areas you think that the financial statement will be likely to be materially misstated. So areas that you think that they will easily get it wrong, you concentrate on those areas. That is a risk-based auditing. So if you are performing your audit work and the concentration is on the risk areas that management are likely to get it wrong, it means that you have adopted a risk-based audit approach. And for risk-based audit approach, it helps you to save time so that you don't waste your time looking at other areas. You want to concentrate on the important areas where you think that management are likely to get it wrong. You concentrate on those areas to perform your audit work. So that method or that approach becomes a risk-based audit method or approach. Please, during the presentation, if you need any clarification, you can unmute yourself or just put up your hand, you're mute, and you go ahead with your question. The next method that we can use to perform our audit work, apart from the risk-based approach or the risk-based method, is the top-down approach. You can also adopt what we call the top-down approach. Another term for the top-down approach is the business risk method or business risk approach. So with the top-down approach, what it means is that as an auditor, okay, so somebody want to ask, how do we identify the risk areas if you are auditing the client for the first time? That's a major reason why understanding of the entity and its environment is very, very important. You need to read about the industry. You need to make a lot of inquiries about the industry so that you be able to identify the risk areas. It's key. And when we get to audit risk, you understand that the fact that that audit client has not been audited before is risky. It's part of your audit risk. The fact that you've not audited the audit client is risky because you may not have detailed understanding of the client's environment. So that one too is a bit of risk. So if you have not audited a client before, it means that you need to read more about the client to help you identify the risk areas. So with the top-down approach, it is also known as the business risk approach. The business risk approach. Why do we call it top-down approach? So when you're going to audit a company, instead of going to audit the financial statement directly, you check what is wrong with the business. Business risk is anything that will affect the business from achieving its objective. Anything that will affect the business from achieving its objective becomes a business risk. So the top-down approach, instead of you going directly to the financial statement, you find out what is wrong with the business and link it to the financial statement. Let me give you a typical example. Typical example is you inquire of management, whether the customers of the company are satisfied or they are dissatisfied. If you're able to prove that the customers of the company are dissatisfied, it's a business risk. Now, how is it going to affect your audit as an auditor if the customers of the client are dissatisfied? Please, if they are dissatisfied, what it means is that management going concern assumption, which is a fundamental issue in accounting and auditing, may not be appropriate. Because if the customers are dissatisfied, management cannot go ahead and say that the company is a going concern. Because if customers are dissatisfied, we all know that obviously it's going to affect or it may affect the going concern of the company. So please, if you want to check whether customers are satisfied or dissatisfied, it means that you are using the business risk approach or the top-down approach. So what is wrong with the business? Then you link it to the financial statement. If customers are dissatisfied, what it also means is that the receivables figure may not be correct. It may not be correct. So once they are dissatisfied, you link it to the financial statement. You start from the top and link it down. Start from what is wrong with the business and link it to the financial statement. So that one becomes a top-down approach. You inquire of management, whether their IT systems are working effectively or not. If their IT systems are out of date, what it means is that the entire financial statement may be wrong. Okay, go ahead, Gideon. Gideon, mute yourself.
Yes, sir. Yes, sir. Yes, sir. Good afternoon, sir.
Good afternoon.
So, sir, with the business risk approach you're talking about, you are trying to say that anything that will affect the objectives of the company is what is going to be your target.
Yes, so you want to find out from them what is affecting them from achieving the objective. What problems are they facing as a business? Okay, then whilst you make those inquiries, you link it to the financial statements. As part of your skill set, as part of the method that you can use. Typical example is what I cited. You inquire of management, whether their customers are happy or not. So if they tell you that the customers are not happy, the customers are complaining, what it means is that their going concern assumption, which is a fundamental issue in accounting, may not be appropriate. It is our responsibility as auditors to assess the reasonableness of the assumption used by management when it comes to issues of going concern. So if they tell you that their customers are dissatisfied, which is a business risk, it means that what they are showing as receivables may not be correct. It means that their going concern assumption too may not be correct. If they tell you that their IT system is out of date or their IT systems are having issues, what it means is that the entire financial statement that has been given to you may be wrong. Are you getting it? Gideon, your hand is still up.
Yes, sir. Oh, no, it's an old hand.
Okay. All right. So that is the top-down approach, the business risk approach or method. Another method that we can use to perform our audit work is the systems audit. Systems audit. Please, ICAG can ask us to explain any of the methods. Systems audit is where, as an auditor, you test the control systems of the client to find out whether the systems of the client are working effectively or not. If you realize that the client will be having bad control systems, what it means is that you need to conduct a lot of substantive testing. You need to undertake a lot of tests of details. That is the substantive testing. If you realize that the systems are working effectively, you can reduce the number of substantive testing that you undertake as an auditor. So with the systems audit approach, it's very, very important because research have been able to prove that companies with proper controls or proper internal control systems will be producing quality financial statements. So if you visit your client and you realize that your audit client is having a very good and effective internal control systems, what it means is that they will be producing quality financial statements. But if you go there and they have weak systems, it tells you that you need to conduct a lot of tests of details. You need to conduct substantive testing because of the weak control systems. So that is the systems method. So if you visit a client and within the finance unit, they have, or the finance department or directorate or whatever, they have a lot of units. And each unit is headed by experienced accountant. Okay, so I have to take the systems audit approach again. I'm still explaining the systems audit. I'm saying that as an auditor, you concentrate on the control systems of the client. If the systems are working effectively, you reduce your substantive testing, which means your test of details. If the systems are not working effectively, then what happens is that you have to reduce your, if the systems are not working effectively, you increase or you deepen your substantive testing, your test of details. Now, typical example is you visit a client and within their finance department, they have a lot of units. Each unit is headed by an experienced accountant, and they do a lot of reviews. They undertake a lot of controls before it goes to the main finance director. One thing is that because they have these controls in place, it's highly probable that that company will prepare good financial statements. But if you go to a particular company, no internal audit unit, no internal monitoring unit, the finance unit, you go and only two people are there. Because of the weak controls, What it means is that their financial statement may not be correct. So when you are auditing said companies, you need to go into their figures. You need to conduct test of details. But if you check the control systems of your client and you realize that they have effective and efficient controls, they follow laws, they follow policies, they are policies to basically everything because they have proper controls. What it means is that they will produce quality financial statements. The activities are supervised. So it tells you that the controls are there. And once controls are there, they will produce quality financial statements. So with the systems audit, as an auditor, what you're supposed to do is that you have to test the control systems of the client to find out whether the controls are working effectively or not. Another method that we can use to perform our audit work as an audit firm is what we call the balance sheet approach. Balance sheet approach. So I've talked about the top-down, the business risk, the systems, now the balance sheet approach. Please, with the balance sheet approach, what it basically means is that as an auditor, when you are auditing a client, concentrate on the statement of financial position. So if you are performing audit work and the concentration is on the statement of financial position, that is, you are auditing assets, you are auditing liabilities, and you are auditing equity. What it means is that you are using the balance sheet approach. But why do we adopt that approach? We adopt that approach because the balance sheet or the statement of financial position is a snapshot of the financial strength of any company or the financial position of any company. And I've been telling people that accountancy is about assets and liabilities. Everything is about assets and liabilities because it increases its income. Assets increases its income. It decreases its expense. The difference between the assets and liability is the equity. And these are the 5 elements. So what it means is that if you are auditing assets and you are auditing liabilities and you are auditing equity, it summarizes the entire financial statement. So instead of wasting time to basically audit everything, if your concentration is on the statement of financial position, it means that you have adopted the balance sheet approach. So that is a balance sheet approach. So we use the old term for balance sheet. So instead of statement of financial position, we're calling it the balance sheet approach or method. Another method that we can also use to perform our audit work is what we call the transaction cycle approach. Transaction cycle approach. So with the transaction cycle approach, what we do is that we select samples of transactions. So you just select samples of transactions and check the trend of those transactions. Check how those transactions have been treated. So your responsibility is to check or select samples of transactions and identify how those transactions have been treated. So if you select, let's say, 10 transactions and you follow it up, you are using sampling method to select, let's say 10, you follow it up and you realize that all the 10 transactions have been treated correctly. You select another 10, do a follow-up on how it has been treated, and you realize that it has been treated correctly. You are not supposed to waste your time to select another sample, or you are not supposed to waste your time to conduct detailed testing of everything. So that is the transaction cycle approach. You are just selecting samples of transactions as an auditor because you cannot go through basically all the PVs. So when you select samples, let's say you selected 10 and you realize that about 9 of them are wrong or have not been treated correctly, what it means is that you need to conduct or open your sample. You need to enlarge your sample. You need to take a lot of samples and check the treatment of those transactions. But if you realize that after taking samples 3 or 4 and everything is right, you can go ahead and express your audit opinion. But if you take few samples, treatment is wrong, you select another samples, treatment is wrong, it means that it's likely that most of the transactions will not be treated correctly. So you conduct proper test of details and widen your sample as well. So that is the transaction cycle approach. The last method that I want to share with you is the directional testing. Directional testing. So as an auditor, you can also test the direction of transactions. One of the fundamental principles or the basic principle that we use in accountancy is the double entry principle. And as we all know, even though a lot of people came in accountancy before Luca Pacioli was seen to be the father of accounting because of the introduction of the double entry principle, because it forms the basis in accounting. It assumes that every business transaction will have the two double effects, a debit and corresponding credit. Now, so building on this principle, what it means is that if the transaction has been treated correctly, what is at the debit side will not be different from what is at the credit side. So with the directional testing, if you have a lot of transactions, if the nature of the transactions that you want to test are too voluminous, what you do is that you check all debits and forget about credits. If you want to go for credits, you check all credits and you don't check debit because of the dual aspect concept. The transaction will have a double effect. One at the debit, one at the credit. So if the figure at the debits are right, it is assumed that what you have at the credit too will be right. And if those are the credit is right, it's assumed that what you have at the debit too will be right. So with the directional testing, the concentration is on directions of transactions. So once you are testing all debits, you don't waste your time to test credits. And if you want to test credits, you don't waste your time to also test the debit of the other transactions. So that is how it works. So these are the methods that we can adopt, or the methods that we can apply as auditors to perform our audit work. So please, if you go to the exam room and you are given a question on any of the methods, you should be in a position to answer it. So these are the methods that we can be examined on. Please, which of the method is most appropriate, okay, and efficient? So please, it all depends on you and your plan as an auditor. And I said earlier that practically you cannot place reliance on only one method, even though for most internal auditors, especially the public sector internal auditors, the IAA, that is the Internal Audit Agency, has specified that auditors adopt the risk-based approach because of the resources we have in the public sector. We cannot be auditing basically everything. So there is a need or a call for risk-based approach, most internal auditors. But for external auditing, it all depends on you. Don't go for only one method, even though the risk-based is key, but you can also adopt, per the explanation, you can adopt more than 2 or 3 methods when you are performing the audit work as an auditor. Okay, any question before we move on? Good. So these are the methods that we can use to perform our audit work, and the examiner can examine us on any of the methods. So please, when we meet it in the exam room, try as much as possible to explain it very well for all the maths. Now, let's look at this area under audit of historical information before we audit risk identification. So in most cases, the examiner will tell you that identify the audit risk in the case study, identify the engagement risk in the case study, identify the principal audit risk in the case study, identify the assignment risk in the case study. So these are mere terminologies. It means the same thing. Audit risk, assignment risk, engagement risk, principal audit risk, they are mere terminologies. So if you have to identify the engagement risk, if you have to identify the assignment risk, if you have to identify the audit risk in the case study, it's basically the same thing. Engagement risk, assignment risk, audit risk. Good. Now let me explain it. When we talk about audit risk, I've already mentioned the other technologies we can be used in place of audit risk. Audit risk is the risk that Audit risk is simply the risk that the auditor will express wrong audit opinion, full stop. The risk that we, the auditors, will express wrong audit opinion is what we call audit risk. So the risk that the auditor will express wrong audit opinion becomes what we call audit risk. Now, let me expand it. Audit risk is the risk that the financial statement will be materially misstated and the auditor's substantive testing will not be able to detect that the financial statement is materially misstated. That is audit risk. The risk that the financial statement will be materially misstated and the auditor's substantive testing will not be able to detect that the financial statement is materially misstated. That one becomes audit risk. So what it means is that the financial statement may be materially misstated and our substantive testing will not be able to detect that the financial statement is materially misstated. So two things here. What it means is that the audit risk becomes the risk of material misstatement and detection risk. Two things. I told you that the audit risk is the risk that the financial statement will be materially misstated and the auditor's substantive testing will not be able to prove that the financial statement is materially misstated. So what it means is that the audit risk has to do with risk of material misstatement multiplied by the detection risk. Let me also expand the risk of material misstatement. The risk of material misstatement, which has to do with the risk that the financial statement will be materially misstated by management, is as a result of two things: the inherent risk and the control risk. So please, anytime you hear audit risk is equal to inherent risk multiplied by control risk. That will give you the risk of material misstatement, or the two is the risk of material misstatement, multiplied by detection risk. So audit risk has to do with inherent risk multiplied by detection risk multiplied by the control risk. So audit risk is equal to IR times CR times DR. That is inherent, control, and detection risk. Please, if you are asked to identify the audit risk in a case study, the concentration should be on identification of detection risk, identification of inherent risk, and identification of control risk in the case study. Just that you are not supposed to write subheading inherent and you identify the risk and the inherent. You can do that as a background workings and you transfer the correct answer to the answer booklet, but just write them together. So the risk that you, the auditor, you express wrong audit opinion is what we call the audit risk. Good. Now, what goes into the inherent risk? In the case study, to spot inherent risk basically deals with the risk that is associated with the nature of the client and its transactions. So inherent risk has to do with any risk that is associated with the nature of the client and what they do. So for example, if you realize that the client is undertaking complex accounting transactions, so by its nature, the client is undertaking complex accounting transactions, undertaking a lot of, let's say, foreign exchange transactions. Foreign exchange transactions is very complex. You need to apply the IAS 21, exchanging the foreign currency to home, a lot of complex accounting related issues. And it will be very difficult or sometimes difficult for management to get it right. That is inherent risk. This can also lead to detection risk because we, the auditors, if you don't understand the standard into detail, it will be very difficult for us to also detect that what they are doing is wrong. Inherent risk because of what they do. If a client is having a complex group structure, one particular client is a parent to about 3 different companies. The same client is a subsidiary to about 3 different companies. The same client is an associate. Complex group structure. it becomes very difficult for the person preparing the financial statement or management preparing the financial statement to do the right thing. And it can also be difficult for we, the auditors, to get it right. If management are undertaking unusual transactions, inherent risk, a lot of related party transactions, inherent risk. The fact that the audit client is new, they have not prepared financial statement before, inherent risk. It can also lead to detection risk because we, the auditors, we find it very difficult to detect that what they are doing is wrong because we've not audited such company or such industry before. It's inherent risk. And it can also lead to detection risk depending on the nature. So any risk that is associated with the nature of the company and its transactions. So whilst you're going through the case study, be checking that related party transaction issues, complex accounting issues, unusual transactions issues, complex group structure. These are inherent risk. Then the next one is control risk. Control risk has to do with the controls of the client systems. Do they have proper HR policies, organizational structure, the controls? Who are the management of the company? What are the experience level, the knowledge level of the company, the management? Are they losing key management? So what are the controls? If they have proper controls or they don't have, whether they have proper controls or their controls are not adequate. So please, that one can also lead to control risk by checking the controls deficiencies, what cause fraud. So raise them when a question is given to you. Management philosophy, their culture, policies that are available, whether they have internal audit unit, internal monitoring, audit committee, do they have proper controls? If they don't have proper controls, it means that it may lead to audit risk. Then the last part has to do with the detection risk. Detection risk is from the audit firm. The audit firm ability to detect that the financial statement is materially misstated. So with the detection risk, if the client is new or if the client has not been audited by the audit firm before, or if the audit firm don't have understanding of that entity and its environment, if you don't have understanding of that particular entity and the nature of the industry, it can also lead to detection risk, which is part of audit risk. So if you have not audited the client before, if the client is new, it has not been audited before, it can also lead to detection risk. With the detection risk, if there is complex accounting issues, complex group structure, it can also lead to detection risk because if you have a lot of financial instruments, a lot of foreign exchange transactions, and the auditors don't have control over those standards because these are difficult accounting standards. If the auditors don't have control over those standards, when management are getting it wrong, the auditors will find it difficult to detect that it is wrong, which will lead to audit risk. Because audit risk, as I've explained earlier, is the risk that we, the auditors, we will express wrong audit opinion. The financial statement may require a qualified opinion and we go and give adverse opinion. Or the financial statement may require adverse opinion and we go and give unmodified opinion. That is audit risk. The risk that we will give wrong audit opinion. The risk that the financial statement will be materially misstated and our substantive testing will not be able to detect that the financial statement is materially misstated. So please, for the purpose of the exam, if you are given a question on identification of audit risk, which is popular in the exam room, or identification of assignment risk, is a mere terminology. It means the audit risk, or identification of engagement risk, or principal audit risk. We are talking about basically the same thing. Just raise issue of inherent, raise issue of control risk, raise issue of detection risk. Any question for me before we close for today? It's exactly 1 p.m. Any question?
Yeah, yeah. On when
Okay.
you're talking of the approach, we one approach I didn't hear of it is the balance sheet approach. Is this to be considered or?
Yeah,
And,
I think I mentioned the balance sheet approach. So if you were
okay.
following, I mentioned the balance sheet approach, and I said that with the balance sheet approach, is basically looking at the statement of financial position. Don't waste, if you want to go by that approach, you don't waste your time auditing the income statement. You don't waste your time auditing the cash flows and other information. Concentrate on only the statement of financial position. Or if your audit methodology or approach is to audit assets, liabilities, and equity, it means that you are using the balance sheet approach.
Okay. But my second issue on
Yeah, somebody else asked a question. Let me finish with. Okay, the person mentioned that another term for audit risk. I said that it's engagement risk, assignment risk, or principal audit risk. These are mere terminologies. It means the same thing. Please, you can go ahead.
My issue is on the detection risk.
Detection, yeah. Okay.
Yeah. Some books are talking about business risks, financial risks, operational risks. How do you reconcile this?
Okay, so when we finish with the audit risk, we'll go into business risk. And the business risk is the risk that the business will not be able to achieve its objective. And that one is as a result of three things: the financial, the operational, and the compliance. So when we get to the business risk, that is where we talk about the financial, the operational, and the compliance. That one is for business risk. It's not audit risk. Audit risk has to do with the inherent, the control, and the detection risk. So I getting the difference?
All right, I'm getting.
All right, okay.
Thank you.
Hello, sir. Sir, can you please throw light on the substantive testing approach?
Substantive testing basically means test of details. Undertaking test of details, going into the details. So for example, if you realize that the controls are weak, so instead of you brushing over it, you undertake test of detail. That is the meaning of substantive testing. You request for a lot of documents, you do recalculation, you want to actually go into detail and confirm some of the figures in the financial statement. That is substantive testing. You are undertaking test of details. Okay, Priscilla, go ahead.
Okay, so the substantive testing, is it different from the systems method, or is the same thing?
Is it different from
Systems method approach?
No, with the systems method approach, the systems approach will lead to substantive testing. Systems approach basically means that as an auditor, you are checking the system, the control systems of the clients to find out whether their controls are good or not. If you realize that their controls are good, you don't waste your time to conduct tests of detail because they will get it right. You don't undertake detailed testing. But if you check the systems or the controls and you realize that they have weak controls, it means that you have a lot of work to do. You need to undertake substantive testing, which happens to be tests of detail because they have weak controls. So if you're going to audit a particular company and you realize that there are a lot of professionals on board with their clients, it means that they'll be doing the right thing. And because they'll be doing the right thing, you check one or two things and you realize that is right. You don't undertake tests of detail because it's going to be a waste of time. They'll do the right things. But if you go and the systems or the controls are weak, that is where you undertake detail or substantive testing. So the system testing is just a method. But once you check the method, it will prompt you to go into detail or conduct substantive testing or not. Okay, the person using iPhone, you can go ahead. Unmute and go ahead with your question. I can see iPhone 11, but the name is not here. So just your hand is up. Just unmute yourself.
Okay, sir. Yeah. I want to know that if we are talking about risk assessment, maybe you are in the exam room, you are given a question to identify the risks in a question and maybe talk about it, how it can be treated or what procedure can be used. How will you identify in the question that this is a system risk or this is maybe other risks that maybe they might ask us? So maybe as we go on, if you can give us some examples that will help us identify those risks. So in the exam room, when we see them, we know that this is the risks that we are applying it.
Yeah, I think your question is clear. So with the identification of risk, if it is audit risk, I told you that in the exam room, we're looking for issues relating to inherent. We're looking for issues relating to control. We're looking for issues relating to detection. Sometimes the technologies are a bit technical. So practically, find out if in the case study, they are telling you that the audit client is new, the company is new, just raise it. So the fact that the company is new, it will lead to this. In the case study, if you've been told that they are undertaking a lot of foreign exchange transactions, just raise it as part of the audit risk. In the case study, if you are told that they are undertaking a lot of complex or the group structure is very complex, you raise it. In the case study, if they are doing things that will lead to fraud, it's a significant audit risk, you just raise it. And when it comes to business risk, which we're going to discuss, God willing, next week, Monday, with the business risk, we'll be checking financials, we'll be checking operational issues, we'll be checking compliance issues. So if you realize that the client is not complying with the laws and regulations, then it means you have to raise it. So I believe that the understanding will be more clear when we meet next week to discuss the business risk, and I'll try and distinguish between the audit risk and the business risk. The audit risk is about the auditor, you expressing wrong audit opinion. What will cause that? It's what we've discussed. We're going to look at the business risk, which is as a result of the financial issues, the compliance issues, and the operational issues. Eben.
Yeah, about what my colleague just asked about the audit risk, the inherent risk, control risk, and the detection risk, and the response you gave, it means that you don't need to necessarily link it to the risk that this is a detection risk, this is a control risk, or this
excellent,
is
excellent, excellent, excellent. You are not supposed to do that, to indicate that this is that, this is that. And I told you that in our last meetings, maybe last 3 meetings, by that time we'll be done with the whole syllabus. I'll take 3 or 4 practical questions and go through with you so that those who are here and want to write, you don't have a reason to fill this paper. You should go write and pass it easily with ease. And I'll give you the techniques, all the techniques that you need to pass this paper as well. Okay, any other question? If we don't have any other question, thank you for joining. Nice weekend to all of you. We'll meet, God willing, next week, Monday, to continue with our discussions. Thank you.
Thank you.
You too.
Bye-bye.
Thank you very much.